$25,000 a year. After federal tax, FICA, and state tax, that's $1,733 a month. The average one-bedroom apartment in the United States costs $1,654 a month. That leaves $79. Not for investing, not for emergencies, not for student loans, groceries, car insurance, or utilities. $79. For everything else. This video tracks what actually happens to your money at 6 salary levels from $25,000 to $250,000 a year. Not what should happen. Not the ideal scenario. What the math says happens when you apply average American expenses to average American salaries. The numbers are not comfortable. That's the point. Level 1, $25,000. You check your account before buying groceries. Not because you always do this, because you have to. $25,000 is roughly full-time at federal minimum wage. It is also entry-level retail, food service, and 40% of all jobs held by Americans under 25. Here's what the month looks like. The math produces a deficit before the car payment. This is not a budgeting failure. This is arithmetic. What keeps people at this level is not laziness. The numbers do not add up, and when numbers don't add up, you borrow the difference. 61% of Americans earning under $30,000 carry credit card debt month to month. The average balance, $4,800. At 21.52% APR, that costs $86 a month in interest alone. Interest on debt they took out because rent exceeded income. The system charges you for being poor. It does this automatically. The mechanism requires no malice. It requires only math. And the math has been here longer than you have. Level 2, $45,000. The national median. This is where most people live. If you earn this, you are by one definition, average. Here's what average looks like. The numbers still don't balance. Not because $45,000 is an unusual salary, because the cost structure of an average American life has grown faster than the wages that are supposed to fund it. Between 2019 and 2026, median wages grew 24%. Rent grew 38%. Car insurance grew 52%. Groceries grew 31%. This is why the single-earner household effectively ceased to be the American norm. Two incomes exist in part because one income can no longer cover one life. Those who remain single are quietly funding the gap with revolving credit card debt. The average single earner under $50,000 carries $6,200 in balances. The credit card doesn't fill the gap. It delays the moment when the gap becomes visible. The credit card company calls this a product. The person holding the card calls it normal. It is normal. That's the problem. And normal, left unexamined, becomes permanent. Level 3, $75,000. This is the first salary where the math changes, but not in the way most people expect. At this salary, something shifts. Not dramatically. Not obviously. But for the first time, the numbers can balance if a specific choice is made. $1,217. It will not stay left over. Research from J.P. Morgan Chase Institute, tracking 2.5 million households, found that for every $1,000 increase in income, $800 of new spending appears within 6 months. The mechanism is not extravagance. It is normalization. You move to a slightly better apartment. You upgrade the car. You say yes more often at restaurants. You subscribe to things. Each decision seems reasonable. Collectively, they consume the surplus. Not because of one dramatic choice, because of 50 small ones that each made complete sense at the time. This is the first salary where a gap is structurally possible. Whether it gets created is the only question that matters over the next 30 years. Level 4, $100,000. The psychological threshold. And the one statistic about this salary that most people refuse to believe. For decades, this number carried symbolic weight, 6 figures. The threshold of arrival. Here's the threshold. 68% of Americans earning over $100,000 report living paycheck to paycheck. They are not confused about this. They know exactly where the money goes. They know it before the month starts. The paycheck arrives on Friday. The rent is already scheduled. The car payment is automatic. The subscriptions run in the background. The dining charges accumulate the way they always do. A Tuesday lunch here, a Saturday dinner there. Each one reasonable, none of them budgeted. By the third week, the account is tighter than it should be for someone earning this salary. They tell themselves they'll track it more carefully next month. They have been telling themselves this for 3 years. The number changes. The gap doesn't. Economists call this lifestyle inflation. It is the primary mechanism by which high earners accumulate nothing. It requires no dramatic failure. Only the decision made monthly, automatically, to spend what arrives. Level 5, $150,000, where the tax system changes what the math means. Here's what happens to every additional dollar earned at this salary. Federal marginal rate, 24%. FICA, 7.65%. State income tax, national average, 5%. Combined marginal rate, 36.6%. Every dollar of overtime, every bonus, every side income above this threshold loses 37 cents before it reaches the bank account. The salary that feels like arrival is also the salary where the tax code begins systematically removing tools that were available at lower incomes. The person here who manages lifestyle inflation poorly will have no portfolio, and a 37% combined marginal rate on income they never kept. Level 6, $250,000, the number where the system finally begins to work differently. Not because of the salary, because of what becomes possible. The investment math. With discipline, the portfolio crosses into a phase where annual market returns exceed annual contributions. The money starts making more money than the person is adding. This is not magic. It is arithmetic. The same arithmetic that produced deficits at $25,000 now produces surplus permanently. The average American who earns $75,000 consistently and creates a gap with discipline will accumulate more wealth than the average American who earns $250,000 and doesn't. The salary is the input. The decision is the variable. The math is the output. Most people focus on the input. The output is determined by the variable. Here is what the 6 levels have in common. At every salary from $25,000 to $250,000, expenses expand to consume available income. At $25,000, the gap is almost impossible to create. The math is designed against you. At $75,000 and above, the gap is structurally possible for the first time. The person who earns $75,000 and creates that gap, $500 a month consistently, will accumulate $1,130,000 over 30 years. The person who allows the surplus to normalize, which is what the data says most people do, will have their paycheck every 2 weeks for 30 years and nothing else. The salary is the input. At $25,000, that decision is made for you. The math leaves no room. At every level above it, the room exists. Most people furnish it with expenses and call the result a lifestyle. Some people leave it empty and call the result a portfolio. Both are choices. Only one of them is visible at the end of the month. One question: what salary level are you at right now, and what does the monthly math actually look like? Drop the number below. No context required. Subscribe.